the more tax you pay, the more income you have to pull out of your accounts to sustain your desired lifestyle in retirement. If taxes go up, more income must come out to sustain the same lifestyle. Well, the more income you need from your portfolio, the more risk you have to take to get the returns because your hurdle rate goes up for your retirement, right?
Yeah, you hit it right. I always say that in every one of my public television programs, and I've done it for 15 years. I said, you want your plan or the government plan? But you hit on something that's the key to all of this in tax planning. Actually, two keys. But my always rule, tax planning is just so simple. It's just most people are short-sighted. Here's the foundational principle of always paying the least amount in taxes. And here it is. I call it my always rule. Always pay taxes at the lowest rates. That's pretty simple. But the key to that is control. You want to control your tax rates. You'll always end up with more money when you control your tax rates. If you do nothing, like most people do, because their advisors tell them, because again, they're not educated. They just know the bare bones rules. Actually, the biggest problem with most advisors, they don't know that they don't know, and it makes them dangerous. So an average retiree will say, come to an advisor, well, I've accumulated 3, 4, 500,000, even $1 million in my IRA. And the first thing they'll say, oh, don't worry about it. You don't have to touch it till age 73 when RMDs kick in. They say, oh, that's great. No, that's not great. That's all those years you blew low brackets, or CPAs that brag to me and tell me, oh, Ed, you're going to love this. I kept my client in a 0% tax bracket. 0% tax bracket. And I say, I'm sorry to hear that. You wasted all those low brackets. The key to it is getting the money out, like I said before, when rates are low, even if it's not required yet. Use that 12%, 22, 24 historically low rates. We may never see them again. So people say, well, in my 60s, yes. I'm not saying take it out and buy a new TV. Convert it to a Roth IRA while rates are low. Taking down this growing building tax debt and building up in tax-free vehicles like Roth IRAs, like life insurance. Anything that grows tax-free, you'll always be better off with.
No question about it. Ed, walk me through, just for the layman out there, what exactly is a Roth IRA conversion and how does it work?
Oh, a Roth IRA conversion, it's the greatest thing. It's the greatest account ever created, a Roth IRA. It's the promised land, the holy grail, whatever you want to call it. Can you imagine an account that grows absolutely income tax free for the rest of your life? No required minimum distributions. You're totally free during your life. And even under the Secure Act, 10 years later for your beneficiaries, 10 more years after death of tax-free growth. So the way to do it, and the reason most people and most advisors, including my own colleagues, CPAs, frown on it, because again, they're short-sighted. So here's the catch. If it's so good, why doesn't everyone do it? The catch is you have to pay tax to get into the club. The Roth IRA club. So you move your traditional IRA, you convert to a Roth IRA, and let's say you move $100,000. Well, you're going to have $100,000 of taxable income. And my colleagues, the CPA, some of them come around, but they say, oh, the horror, paying tax before you have to? What a fool, So people don't want to, nobody wants to write a check before you have to. But if you can show them that by paying tax now at lower rates, you're going to substantially reduce your future RMDs or eliminate them altogether, and which in turn can start other things working in your favor, like avoiding those increases in the Medicare premiums through the Medicare IRMA charges or Social Security tax or other taxes that are related to income in retirement. The last thing you want is in retirement to have your income at the highest rates. Many people think they'll be in a lower rate in retirement, but doing nothing is not an option. If you do nothing and you don't convert and you think, I'm saving money, look, my accountant's so proud of me, I'm saving all this money. Then at 73, this stuff kept growing. It's a growing, building, compounding debt. You're building debt. Your IRA is an IOU to the IRS. I say that in every consumer seminar. You are building debt. Doing nothing is not an option. It's growing, growing, growing. Then at 73, you'll be forced to take that out. And that's when you lose control. Then it's out of your control. If you convert like a series of Roth conversions, you don't have to do it all. Taking advantage of the low brackets every year, you control the taxes you pay. You could say, I'm only going to pay up to 12%. I would actually pay up to that 24%. A married couple under today's rates and brackets could have almost 400,000 of taxable income and still be in the 24% for the top dollars. It's the deal of the century. Remember, this money is going to be taxed. It's not if, but when. So as long as we know it's going to be taxed, get it while it's on sale. Taxes are on sale. Everybody loves a sale, right? Look how everybody tramples each other at Black Friday to save $10.
That's terrible. Yeah, they'll fight over a television ad. It's mind blowing. Here's what's crazy. We've got the big beautiful bill trying to get pushed through the House and Senate right now. And it is poised to extend the Trump tax cuts.
Right. That's
under
great.
The Tax Cuts and Jobs Act. However, it's not doing much to decrease spending. And we're sitting here with rates at all-time highs. So we've got debt at all-time highs, all right, rising quickly. I think we're printing $1 trillion in debt every 120 days right now. Yet tax rates are historically low. Ed, what are we doing here? How does that dog hunt?
All right. I asked the same question. I do a podcast, I don't know if you know, with Jeff Levine, the Great Retirement Debate. And one of the episodes we just recorded, it hasn't aired yet, because I've been saying this for 40 years. In fact, every one of my books, this is the latest one, talks about the retirement savings time bomb. And I've been talking about that. But now I'm wondering, because I believe as a CPA, a tax advisor, I've got to believe in math, in regular math. It doesn't add up exactly what you said. How can you keep going? The whole country is running on a credit card. I don't know if it's 38, 39 trillion. All I know is if they have to round up to the nearest trillion of debt, that's a problem.
And big problem.
Now they're saying this bill could end up doubling it to, 80 trillion. The numbers are astronomical. Maybe I got to believe tax rates will go up, and the ones who are going to be caught in the soup when the music stops. I know that's a mixed metaphor. I wrote that once in one of my books, and my editors said, no, that's a mixed metaphor, with a red pen like I was in school or still. But when the music stops, who's going to be left paying that bill? Anybody the people with the most money in tax deferred accounts, IRAs, 401ks. That's why I say get that money out of there now while rates are low. So I do believe rates will have to go up, but politically, I don't think you're going to see large tax increases because it won't sell until it's an extreme situation. That might not even be in our lifetime, but you can set this up now. Even if you don't believe, if you think Congress, and I'm starting to think that, Congress will just keep kicking the can down the road and never really raise rates, why do you want to worry? What you can do now, you can lock in today's rates. You can get certainty, stability. Don't have to worry about anything in retirement. Imagine knowing your retirement rate, tax rate is 0% on a Roth IRA. You can lock that in. So rates may not go up as fast, but I don't think they're ever going down. So you asked about the Roth. The Roth is a big, giant bet that you believe rates will go up. But even if they don't, I call the Roth IRA tax insurance. It's insurance in case, what if they do go up? So I don't know the answer to that. Mathematically, they have to go up.
There's no question that some way IRMA's going to go up. The deductions are going to be less. They're going to figure out ways to skin us. They have to. All right. There's $36 trillion in deferred accounts, IRAs and 401ks.
Yeah, more than
Uncle
that.
Sam's
Over
licking
40
his chops.
trillion. Yeah.
40 trillion. So if the government gets 24% of that, or 25% or 30% of that, that's a lot. Here's what's really interesting. Is Trump ran on tariffs, right? We're going to tax China, for instance, to do business in the U.S. Well, in 2023, I think the government took in $2.2 trillion of tax revenue. Okay. Well, and they took in $100 billion approximately of tariff revenue. All right. So in order for tariffs to make up the tax revenue and abolish the IRS, which is never going to happen. No. All right. The $3 trillion that we took in imports in 2023, they would have to tariff those at 70% to equal the $2.1 trillion in lost revenue in the form of taxation. It ain't happening, folks. It's only going to go up and it's only going to get worse. I believe that in a big way. And let me ask you this question, and I want to clear this up. This is one of the most mind-boggling things to me, even as I talk to advisors around the country myself, they don't understand something. Tell me about the 5-year rule on the money you put into the Roth IRA conversion. How does that work?
If you use Roth IRAs for the way they're intended, you don't have to know anything about the 5-year rule.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.